Good afternoon. Welcome to this webinar discussing the results of the SEPS-ECME study on EU CCP policy and markets, entitled More Than Meets the Eye. We have about 300 persons registered for this webinar, which shows how much interest there is in a very rather technical, difficult issue to explain to a broader public, but it shows the importance of the matter. And I think it also comes at a very good moment, as the EU Commission has just announced its prolongation of equivalence with the UK, on which John Berrigan will say certainly something in a moment. The study which we did, and which I think you all have seen, it was posted at the end of October on our website and has in the meantime been downloaded many times, was done in cooperation with FIA, ISDA, EBF, EFAMA, but it's also the result of many questions with interviews, surveys with market participants, with regulators, with supervisors and academics. You find some of the names in the introduction to the study, but there are also people who prefer not to be mentioned. So there are plenty of people who have given us advice, which is, I think, important also for this subject, which is, again, to understand how this market works, you need to have a lot of insight from market participants, which we got. And in this sense, I would like to have also special thanks to the person who helped us a lot into that. It is Corina Schrem from FIA, who acted a bit as a moderator between us and the market participants and in the many different meetings which we had to discuss our initial results. What we'll do now is present the results of our study. I will give the floor in a moment to my colleague Apostolos, who did the study with me. And then we will have comments from John Berrigan, Director General of DG FISMA, from Danuta Hübner from the European Parliament, also member of the Econ Committee and rapporteur for the EMIR 2.2, and Frucolin Wentz, who's a steering committee member of the CCP board at the ESMA Supervisory Authority. And it will be followed by questions and answers. We should certainly have more than half an hour for questions and answers. You can raise questions and answers just by appearing on the screen also, or by indicating a question in the Q&A box. If you want to raise a question, you can flag it, and we will just make sure that you can also raise your question in person, and we can bring you up onto the screen. So I pass the floor to my colleague Apostolos, who has a few slides to go rapidly to the results of our study, and then we will go to the different commentators. Apostolos. You're on mute, Apostolos. You're on mute, Apostolos.
Yes, thank you, Carl. Let me share my screen. So I hope you can see it.
Yes.
Good. So before starting, I would like to say a few things about, what was the main purpose, the aim of this study, why we did it. I mean, the answer is that, we wanted to be an informative study, not only about what is clearing, why clearing is important, what are the advantages of clearing in terms of risk mitigation, efficiency, transparency, but also what are the concerns with the concentration of risk, which of course imposes financial stability questions, but also with costs related. The market and the derivatives market has evolved enormously over the last 10 years since the global financial crisis and the G20 commitments. In EU, we have EMIR since 2012, a very important piece of regulation, which was very welcome and perceived well from the industry. The recent review of EMIR 2.2 provide further strengthening the powers of ESMA for third country, for supervising third country CCPs, but not EU CCPs, which are still under national supervisor, but also strengthens the role and the powers of the central bank of issue. Meanwhile, also CCPs have risk management tools, initial margin variation, collateral, default fund. So the market has become more transparent and in some way more safe than before. The second part of the study was to look about some case studies, some examples, look in other jurisdictions and see what we can learn from them, from Australia, Canada, Japan, jurisdictions that decided or were thinking to introduce a requirement for the clearing of the national currency denominated products at the domestic CCP. So what we can learn from that, and what is the important things to be considered when we're discussing about an EU CCP policy. As Gabriel said, we use a lot of different data. There is a lot of information in this report. We look at national amounts outstanding, notional traded, notional registered turnover, everything. So here I'm just showing, just to start a bit the discussion, global notional amount outstanding of OTC interest rate derivatives. Of course, most of the focus of the report is on interest rate derivatives, which are the most active asset class of derivatives, but we should not forget also other important derivative products like commodities, oil, coal, gas, and so on. But here we focus on the currency denominated and highlighting two of them across CCPs. These data refer from the Q2 2021, about 80 trillion LCH and about 21 trillion at Eurex clearing. But it's important also to see how the market developed and compare these volumes with the volumes 3-4 years ago. So just to highlight, back in 2017, 4 years ago, LCH was about at 81 trillion. So there is a marginal decline of about 1-2%. But at the same time, the volume Eurex increased significantly from about 1.5 trillion to what is today 21 trillion. So the market has evolved and developed a lot. Now, if we want to move a bit deeper into the CCP's share of cleared interest rate swaps, now we move to swaps, which is the most active, let's say, product type of interest rate derivatives. And we look essentially at the global trading activity of cleared interest rate swaps in the first half of 2021. So this is latest data. What we see, 94% of euro-denominated interest rate swaps traded globally were cleared in the UK, while the remaining 6% in EU-based CCPs. It's interesting also if you look in other currencies, for example, the percent of dollar-denominated IRS cleared in UK is even higher, 97%, while in the other side of the spectrum is Japanese yen, which largely 3/4 are cleared domestically, mainly by the Japanese GCC CCP. Now, it's interesting also to focus on euro interest rate swaps and see what is the relationship between execution and clearing. So where trades are executed and where they are cleared. So this is the flow chart. And what we see is that actually there is a small fraction of euro-denominated IRS that are executed on an EU trading venue and cleared in the EU, within the EU by an EU CCP. So this is the 3% on the right side of the flow chart. On the other hand, 17% of the euro IRS executed through an EU trading venue, they are cleared by UK CCPs. So essentially, this implies that any requirement for euro-denominated products to be cleared locally will affect a rather small share of the euro IRS market, and maybe the counterparts domiciled in the EU. But of course, this is not a small fraction, it cannot be neglected, but somehow is rather a small part. Now, looking a bit in a broader perspective on the currency composition across years, so over the last 20-21 years, 2-3 interesting observations. The one is about the euro-denominated products, which up until 2013-14 were the most, let's say, active in terms of notional amounts outstanding, about 40% globally, And since then, euro-denominated products reached the today level of 28%. At the same time, opposite path for the US dollar. Another interesting observation is about Japanese yen. Japanese yen at the end of 90s, beginning of 20s, about 20% globally, and gradually down to 8%. I'm saying that because we look, as I said, to other jurisdictions, where we look at Australia, Canada, which of course are much more smaller size compared to the EU, but we also look at the Japan and what was the lessons that we can learn from there, where the authorities considered to introduce a requirement for clearing national currency denominated products in a local CCP. What they decided, market participants, what they decided, regulators there, was to allow market participants to decide themselves where is the most efficient, where is the most effective way to clear local currency products. The aim was to minimize disruption, to minimize the introduction of regulatory requirements, the increase of costs that allocation policy would have. Instead, they decide to go for strengthening the regulatory cooperation between jurisdictions, between Australia, Canada, and the UK. Importantly, and this is also something that EU now achieves with the extension of equivalence, to maintain oversight powers over third country CCPs, to have a robust recovery and resolution regime, very important. And the main conclusion we can say that was that global CCPs provide liquidity, provide efficiency, which is necessary in order to navigate and to resist the financial shocks. And now, what we can learn out from that, that's the question. I mean, we think of three important considerations here. The first is financial stability. So, as I said, it's equally important oversight of UK-based CCPs, how to strengthen the cooperation and supervisory relationship between the jurisdictions. In terms of efficiency, what is the most efficient, effective way in terms of cost, fragmentation, liquidity, transparency, innovation, everything can come there. Future development of EU capital markets. So any consideration of having an EU CCP policy should be in the context of capital markets union, should be in the context of how we can develop our capital markets. And of course, as we said also with the previous graph about the international role of euro, how to strengthen it, how to make it more important. Two last things, of course, derivatives are global markets. So this means that it's not something that we can move easily. London developed over the last decades and in the context of the single market. And as we saw in the first table, also over the last 4 or 5 years, the market developed and moved towards Eurex and will continue to evolve over the coming years. And the last thing is that, of course, CCPs are highly interconnected with international financial institutions and global banks. Economies of scales are huge. Network effects result in a natural tendency towards large-scale concentration. So here comes the question about competition, fragmentation, financial stability. Is there a trade-off between them? What is the right balance? But of course, on the other hand, we have to think also that this comes with the expense of price setting, costs, reduced liquidity. So it's a rather, holistic approach that should be followed, and having a long-term perspective and view on how to develop the EU CCP policy. And I'll conclude here. I'm open for questions and interesting to hear John.
Okay, thank you. Thank you, Apostolos, for this introduction. You find the study on our website. You see the websites here. CEPS is an independent research institute, a think tank based in Brussels. ECMI is managed by us as a smaller entity which looks at capital markets development. So you can find the study over there, and there is much more than what Apostolos just managed to develop. We will move now to the panel. I think we can be very grateful. We have an excellent panel, and we start with John Berrigan, as I said, Director General from DG FISMA, who's been closely following this certainly over the last days as well. So, John, what do you think about our findings, but also more importantly for all the market participants, how are we going to evolve over the coming months and years in the context of the policy set by the EU Commission for CCPs?
Okay, well, thank you, Cara, and thanks very much for the presentation as well. I mean, we've read the study, and I mean, from a factual perspective, we have not much to disagree with. I mean, if the facts are there, we don't question the facts. I think we also accept the specific features of the market. We know this is a very specific market. We know the importance of liquidity. We know that there are complications in moving liquidity. There are costs involved. We're also well aware of the G20 commitments that we've signed up to here. I suppose the main point I want to make is that the objective of what we want to do or may want to do is not to fragment the market. Okay, we're not out to fragment. We want to address what we think is a medium-term strategic vulnerability, and I'll come back to that. The consequence of that may or may not be to fragment or to fragment to different extents, but that's certainly not the objective. And to understand that, you have to recall a little bit of the history. I mean, when the UK were part of the European Union, we concentrated, or not we, but clearing was concentrated in the global financial center. It made perfect sense. And looking at the EU as a whole, there was a balance between our internal and external clearing business. With Brexit, of course, the UK moved outside the jurisdictional boundaries of the EU. That was a fragmenting event. Anything we do now is a reaction to that. The fragmenting event was to move all that business outside of the EU jurisdiction when it had built up there, at least the EU part of it had built up there within the context of the single market. So we are now to think about how we react to that. We suddenly go from a situation where we were fairly balanced in terms of our internal, external clearing activity to a world where we are not very balanced at all. And we fall into the category of, I would say, over-reliance on external provision for some of these services. So this raises this question about medium-term vulnerability. So the question is there a vulnerability there? Now, I noted that there were examples of other jurisdictions there, and we were drawing some lessons from them. But as has been mentioned, in terms of size, none of them quite compare to the EU. So if we were very small, we might have no option here, but we're not very small. We are quite large and intend to get larger, and therefore we have options. And this is where this fits into the whole debate of strategic autonomy, because I need to define the word autonomy. I say often that this doesn't translate well into other languages. It doesn't translate well into English in some parts as well. But autonomy for me is not about self-reliance, it's not about protectionism. Autonomy is about having choices. It doesn't mean that you don't do certain things, but it means you do certain things because you want to do them and not because you have to do them. So it might well be that we would want to have all our business, clearing business in the United Kingdom, but we would do so because we want to do so and not because we have no options. And that, I suppose, is one big difference between ourselves and the United States. The US have, of course, in absolute terms and even relative terms, I see more of their risk in US dollar in London than we do. But they also have Chicago. They have this very developed domestic clearing capacity, which in extremis they could use if necessary. And it gives them, of course, important leverage in the world. We do not have a Chicago. It has been mentioned that Eurex has grown dramatically in the last few years. That is true, but we are not yet anywhere near having a Chicago inside the EU. So in the context of autonomy, we see this as a potential strategic vulnerability. Now, why do you worry about this when everything is going so well? Well, you can use the recent example of the COVID crisis. Nobody was worried about supply chains before the lockdowns. Now suddenly we're all looking at supply chains in chips, supply chains in medications. We shouldn't look at supply chains in finance. Well, why not? So we need to look there as well. So when things are going well, and nobody is questioning the quality of supervision of UK CCPs, but when things are going well, of course, you don't tend to think about what might need to be done if things don't go so well. But my job is to think about what happens when times don't go so well, to stress test, let's say, the relationships that we have today. And when we stress test those relationships, and we think back to the crisis we had in 2008, and unfortunately, even the crisis we had more recently, one can see how certain arrangements that can be taken for granted when things are going well don't quite operate the way you expect. And that's not a question of trust. It's not a question of willful change of behavior. It's just that when the stress applies, certain arrangements are more difficult to implement than others. And you have to think about your vulnerabilities in those situations as well as on the day-to-day basis. All that being said, from the very beginning of the Brexit negotiations, we were very clear that together with the Bank of England, Her Majesty's Treasury and the ECB, we, as you will recall, concluded that the one area where we saw a serious financial stability risk linked to Brexit was central clearing. And I think all sides have been very responsible in the way we've behaved towards this sector since then. There were no sudden movements. We have extended equivalence once. We have announced we'll extend it again. I'll come to that in a minute. So everybody has been quite responsible because we understand that even if we have a medium-term vulnerability, a medium-term stability concern, we don't want to create a short-term stability issue in trying to address that medium-term concern. So we used the period of last equivalence decision to set up this working group. I think many of the industry on both the supply and demand side were contacted by that working group to do a lot of the work, by the way, that Apostolos has done now in explaining to understand all those numbers, to see what were the opportunities, what were the challenges involved in having this discussion about rebalancing our relationship. I think three things came out of that working group. One was that we have issues on the demand side, so we need to make the offer from the EU attractive. We need to build on the demand side. To do that, we have to also work on the supply side, so the offer has to be there. And then lastly, what was concluded was we need to have a supervisory framework that ensures that the oversight of any risk that is emerging on the EU side is properly supervised, and therefore there is no change in the financial stability linked to this location of the business. When you look at what has to be done, it became quite clear that we're not going to get this done by June of next year. So a decision has been taken that since we're not going to be ready, we will extend. We didn't see any point in not telling the market that we're going to extend. So the commissioner has made that decision. But of course, she has also made it clear that she's extending, but this medium-term issue remains on the agenda, and we will need to look at that medium-term issue in the three areas that I've said. We have, of course, the ESMA decision coming forward. Frolan will talk about that, I guess, later. We will wait to see what comes out of that before we decide next steps. But we thought it was important to go out now, since we were beginning to pick up signs of concern, let's say, as we always do, as we approach the end of equivalence decision dates. And we decided to go out and make that clear. But I want to be very clear that although we're extending the equivalence decision, we have not forgotten about this medium-term vulnerability, and we will want to work to see to what extent we can rebalance that. But let me also be clear that in this discussion, there's no question of us suddenly deciding we don't want to do business with the UK anymore and that the City of London doesn't exist. I mean, the City of London is a global financial centre. We will always want to use it because it is next door and it is very convenient. The issue here is one of balance. So it's not one of drawing up protectionism or drawing up drawbridges. It's about finding the right balance in terms of our relationships, in terms of our reliances on certain services. And in that sense, it's not much different from a broader autonomy discussion around other parts of the economy. As I said earlier, microchips, medication, all of these supply chains are now being discussed and being looked at. There's no reason why we shouldn't look at the financial service sector in the same way. We are aware, of course, that there are costs, there may be costs, there may be fragmenting issues. but we will try to minimize those, as we've always said we would. But in the end, we have to find that balance between what the market will want in terms of liquidity and what the market will bear in times of stress in terms of financial stability. And that balance we'll have to work on in the next few years. I'll stop there, Carol, and I'm also happy to take any questions that will come.
Thanks, John. That is very clear. Also very clear how you put it into this broader strategic autonomy debate, and that you said, look, it's a matter of finding a balance, which I think most participants can agree with. Danuta, we move to you as rapporteur for this important piece of legislation, which was adopted, I think, 2 years ago. So you're still in the midst of it, and also in the midst of this, a lot of the discussions on our EU-UK relations. So how do you see your study, but what do you think moving forward should happen?
Yes, well, first of all, thank you. Thank for the report, for this opportunity also to come here and talk and to listen to what Sean has been saying. I think it's also very important for us in the Parliament. I think largely we share a lot of what the Commission is presenting in its perspective. And also the report, I think, is that has brought us here is, in my view, a good, a timely and also needed report, because I think that the authors, both of you, but plus that I understand a lot of people have contributed to it. You put your collective finger on really crucial elements of emerging reality and risks and consequences of choices to be made. I also think in the report there is appreciation of market forces, but there is also a space for policy makers, and it underlines the importance of long-term, of looking at the challenge in the perspective of long-term strategy of building a competitive financial European global center. And it also puts, I think, a lot of attention on the interconnectedness between clearing and other elements of this financial center, and brings also the issue of competition between the CCPs. So I think that there is a lot of very important issues, and my reading of your report is that EMIR is a strong and, I would say, quite sophisticated supervisory framework that caters for very different global financial interactions for both good and bad times. But it is, of course, not cast in stone and not necessarily addresses today all the issues that we can think of. And it is also true that, and we like to underline it, that EMIR 2.2 has not been tailor-made for the time after the UK departure. I remember the discussions we had. But it is also true that this joint group that Sean mentioned, UK-EU top institutions, identified rather early in the process that derivatives clearing is the most risky area, requiring equivalence approach and special attention. And in this context, I think there was no other option for the EU. EU had to find itself obliged to assess the best way to protect its interests, both domestically but also internationally, based on a high degree of coordination required across national competent authorities, central banks of issues and market infrastructures, as well as on an effective oversight and powers over the third country CCPs. And today, when I look back and look at what we have today, it is indeed hard to single out the CCPs issue from the general context of the EU-UK relationship. And ongoing problems look increasingly as a template for the future. I think there is an overwhelming, and I'm saying with big regret, overwhelming lack of trust in this relationship. And we have also a lot of publicly made statements on UK side which disappoint deeply. And that is why I think we cannot just assume that there is no potential, potential disruption and crisis in the area of financial cooperation to be seen. And that's why we have to be to take also this risks into account. I also understand that we are building whatever will be the final decision related to the future on the assumption that there will be divergence of rules and systems between UK and EU, and that there will be times of crisis. And here I share, I think, strongly what Sean has just said. But having said that, I also still see the chances that the regulatory and supervisory framework for our cooperation as two separate jurisdictions can be based on shared values and interests, and both EU and UK can be globally recognized financial hubs that operate on the highest standards in a win-win situation in the future. And we need cooperative approach also to convince, in my view, market participants that what we have is a credible relationship that does not aim at fragmentation of the markets and many other bad things that also Sean enumerated. For this, I think we need enforceable email, and for this we need a rule book and structures which are fit for times when things will not go well. And we need, in my view, further strengthening of the European supervisor, meaning ESMA. On the EU side, a lot of legislative and regulatory work, not directly related to clearing, but work has been ongoing in the area of crisis management, the reforms of EMU architecture, banking union, banking sector, including the finalization of the Basel III. And I'm mentioning these frameworks because they are, I think, of crucial importance for facilitating also the work of supervisors and reduce the risk coming with all sorts of national options and discretions, which I think in this case also matters. And I also think that it is obvious, legitimate, and desirable for European financial powers, if I can use this word, and markets to grow based on an international mindset and also global presence of our financial institutions. And with regards to central counterparties' challenge of excessive exposures, I believe that conditions conducive to voluntary reduction of exposures can be enhanced by policy framework ensuring enforceability, but would require an approach that would not undermine market confidence. And also building up, when I think of building up of clearing liquidity that should be market driven, but again, a rule book can offer, for example, lowering barriers to market entry. My experience, and which I hope many of you would share, tells me that uncertainty, if it goes behind certain limits, can produce damage. And that's why it's extremely good news that the Commission made the declaration about the equivalence. And doing nothing, I think, allowing equivalence to lapse and watching whether clearing moves to Europe should not be an option. And I'm very happy that it is not. And ESMA is currently working, it's my understanding, on a comprehensive assessment of the systemic importance of the UK-based CCPs. And I assume ESMA will also provide data and hopefully methodology for better understanding of excessive exposure issue and the risk for financial stability. But there is, of course, the other issue that Sean mentioned that requires clarification, which is the best path toward development of clearing capacities of the EU-based CCPs. And in this context, I trust that ESMA's opinion, based on good understanding of available data, in which I can imagine within which I can imagine the full picture of the situation will be assessed, will be fundamental regarding feasibility of risk handling, the costs of fragmentation of liquidity, but also taking us closer to answering a fundamental question on whether we can ensure a credible, stable, efficient financial system by having most market infrastructures in other jurisdictions. And the list of accompanying questions is, of course, long, and also the report adds to this question, to this list, including the one whether Europe can have a globally relevant currency without a powerful clearing system, but also whether you can have a stable, credible system based on allocation policy. It's also another perspective on looking into this. So in general, as I said at the beginning, I believe that our rule book on clearing has created a system with strong safeguards against financial stability risks. And I have no doubt that the economy of the size of the European Union has to build its own strong financial power and choose the best available options. Its cooperation with a third country jurisdiction, that's my political part of me, is that in this cooperation with a third country jurisdiction, we cannot base ourselves on trust coming from politics. It must be trust coming from shared interest and supervisory and regulatory cooperation. And I continue to believe that a constructive dialogue between EU and UK leading to an agreement that would facilitate building European financial power would also benefit UK. There is a space for both jurisdictions in the clearing business. Of course, on the EU side, you might find, and it's not difficult, people who would prefer, or figures or politicians who would prefer to have, or market participants would prefer to have relocation imposed. Some would prefer further temporary extension of the equivalence. Some would see a solution without a time-restricted extension of equivalence. But nobody, and I think I know what I'm saying this time, nobody wants a cliff edge solution and nobody wants a disruption of the market. And it does not come as a surprise that when what used to be European financial center is floating away, offering unpredictable future, in all discussions, this issue of exposures and related risks have become fundamental. Especially that, unfortunately, COVID provided evidence that good neighbors can become sometimes less good neighbors. So Commission strongly engaged in the process through various forms of action, consultations, discussions on all options, took publicly the voice last Wednesday. As I said, it's a good news. Market has received a message from this announcement, and we are now awaiting, of course, the assessment from ESMA, which will, I hope, indicate more detailed evaluation, will make it possible to have a more detailed evaluation of choices. But I also trust ESMA will tell us which data we don't know yet. That's also important, I think. I can also imagine that while purely market-based options when it comes to a balanced exposure needs more time to materialize, a regulatory shift has also its credibility risks. And I can also imagine that whatever the choice, it can be seen as a chance to have supervisory and regulatory adjustments and new elements in the approach to the supervision of the EU CCPs. Actually, many of us in the Parliament are hoping that this door will be open. But in my view, main objective of the EU clearing policy is not only financial stability, important as it is. I'm not questioning the importance, but what we need, I think now, is a policy that should improve the competitiveness of EU framework to allow European institutions to access also global liquidity pool, to boost growth of European companies through facilitating raising capital by making also hedging less expensive and more effective. So my last word is that clearing location policy has been designed, and I say as a rapporteur, as a last resort tool, and I think it should stay there. And we, of course, have to look also at the experience that mentioned in the report, which Sean alluded to already, and it's probably worth looking about location policy. Thank you.
Thank you very much, Danuta. Very comprehensive, very complete, but also very balanced. I think your assessment and also looking at the different sides. You referred already to the ESMA report, and I hope Brooklyn will certainly say something about this. I must say about that, we also look forward to that because we had one of the problems which we had for our study was collecting data. I said that market participants helped us a lot, but I'm sure that ESMA will have much more data than we have because many of these data are not publicly available. Brooklyn, happy that you're there and that you can join us. And I think for many people, it will be the first time that they meet you. Brooklyn.
Thank you very much, Karel. And many thanks for the invitation to participate in this distinguished panel and to represent ESMA here on this important topic. As many already alluded to, I would like in this speech tell a bit more about ESMA's assessment. And you can imagine that having done this assessment since the start of the year, being in a phase of wrapping it up, it was very interesting for me to read the ECME report and to be able to compare in a way. So what I plan to do is to tell a bit more about what we do, where we are, what our timing is, what we expect we can more or less communicate without going into the details, because we have not finished yet, and then also share some views about the report that has been the reason for being here. And it is also very interesting to hear the views of Danuta and John, as it is well known, the Commission and ESMA in this area function in a way as a tandem, where the Commission provides, based on its analysis, an equivalence decision about the regulatory and supervisory framework for a specific jurisdiction. ESMA generally, following that decision, decides on the recognition of a CCP in that jurisdiction. I think it's important to mention that, because it's not always clear and it's different from several other jurisdictions. Now, last year in September, we all know, and John alluded to that the Commission provided its equivalence decision, a temporary equivalence decision for the UK framework. And at that time, in the communication, ESMA was asked to provide a comprehensive assessment of the systemic importance of the UK CCPs with the objective to see whether they may be so systemic importance that they can no longer be recognized. Now, this is in a way, I don't think, very different from other jurisdictions, in the sense that every jurisdiction looks into the risks that foreign CCPs pose to their own financial market stability, to their own banks, their own the clients of banks, and have measures in place to identify and manage these risks. Now, in the EU, there is a process full of checks and balances around a potential non-recognition decision, and I think you should see ESMA's assessment in that context. So basically, what we do is that we have looked at the specific EMIR article, which is Article 25(2)(c), and based on that, we have developed a methodology, a very detailed methodology, I think, that we published in the summer on ESMA's website. And what we have defined based on EMIR Article 25(2)(c) is to have two parts in that assessment. The first part is an assessment of the systemic importance of the two UK CCPs, and we speak about LCH Limited and ICE Clear Europe. And the second part, well, with the objective, let me first speak about the first part, with the objective to really analyze in depth how systemically important these CCPs are for the EU, and whether there are maybe scenarios in which, even if these CCPs fully comply with EMIR, there might be risks propagating from the UK to the EU. And for that purpose, we have developed or analyzed better several scenarios of how that can take place. And we have used the typical systemic importance indicators to construct the analysis: size, interconnectedness, it has been mentioned before, whether there are maybe any alternatives available, what the buffer capacity is in the EU, etc. And the second part is a cost-benefit analysis. Suppose we would identify that the CCPs, the UK CCPs, or maybe some of their clearing services are of substantial systemic importance. In other words, they are so important for the EU that, and we don't have the right tools to manage these risks, that we cannot recognize them. What would then be the cost and benefits for the EU? And again, in the methodology that we published this summer, you can find the different elements that we have analyzed, and you will recognize many which are very similar to the ECMI report that Apostolos presented. Now, we have collected data is already mentioned several times. We have collected a huge amount of data over the summer, also with thanks to FII and ISDA, FIA and ISDA. We have received data from the 2 UK CCPs, also from EU CCPs, clearing members, clients, trading venues, but also public sector. We have spoken with many European institutions, central banks, national competent authorities, the ESRB. And based on this, we have been able to conduct the assessment. We are currently in the phase of wrapping up, and the result will be that we will conclude in the end, well, first, are any of the CCP clearing services of substantial systemic importance? And second, suppose we would not recommend not to, how do you say, recognize them, what would be the cost and benefits for the EU? And based on that, we will communicate to the Commission, as it is specified in EMIR, whether or not to recognize the CCP. And I expect that we can take this decision in the near future. And several references have been made to the statement of Commissioner McGuinness, where she indeed refers to ESMA's upcoming report, expecting measures or vulnerabilities that we may identify in the ESMA report that may help the Commission define measures. So this is in a nutshell the assessment that we are currently doing. We are in the process, as I said, of finalizing the report. We do that with the CCP Supervisory Committee, which consists of national competent authorities, of CCPs, central banks of issue, and of the 3 independent members, of which I am one. We will consult the ESRB. We will ask agreement of the central banks of issue for the currency concerned. And then the ESMA Board of Supervisors will have to approve our report and the accompanying communication to the Commission. Now, since it's not yet finalized, I cannot share findings and conclusions. I hope that we can do that at a later stage, but I can share some considerations to the benefit of the discussion today. I share the view of Danuta and Sean that the report of ECME identifies clearly and comprehensively the cost of a non-recognition. And you will also see probably later in our report, but also with the reference to the methodology, that we have also evaluated each and individual cost that is mentioned. I would like to add, and that is very much in line, I think, with what Sean was saying, that there are not only costs of a non-recognition. I think there are also benefits, and they relate to the ability of EU supervisors, EU authorities, especially in times of crisis, to access information and to be able to intervene effectively. And I think, and just to have the picture complete, that a benefit of a non-recognition, under the assumption that the clearing flow following a non-recognition will move to the EU and not to another third country, will strengthen that ability within the EU to manage crisis. Now, if you balance that benefit with all the different costs, how does that weigh? How do you weigh these against each other? That is not for me to mention at this stage. That is something, as I said, for the relevant EU authorities to decide. But I think it's important to mention that we have also considered this benefit. And whatever the outcome is, and that's also one of the statements in your report with which I fully agree, close cooperation between the relevant authorities is becoming ever more essential to ensure that the risks of CCPs are adequately mentioned in good and bad days. And this requires high levels of trust and transparency in order for the actors to allow swift and efficient reaction in times of crisis. Now, cooperation is not without difficulties, as every cooperation is not without difficulties. And we need robust arrangements that establish workable frameworks for the exchange of non-public supervisory information. And I think a valid question in this context is whether there are limits to what can be achieved by cooperative arrangements and colleges. Let me end with one thought about the way forward. So the proposed way forward in the report is to develop the EU clearing infrastructure within the context of the Capital Markets Union. And this is indeed one way forward. It does not recognize, in my opinion, the urgency of the issue. It's a very important project to develop EU capital markets, which takes time, as is the case with any project to develop markets. And I've worked also for the IMF and World Bank, so I know that this takes time from my own experience. Whereas the risks and dependencies of the EU on the UK are large and imminent and need attention and decisions in the shorter term. Thank you very much.
Thanks, Frukelien. Very clear, very much to the point, but also we look forward to the ESMA report, but you've also made that clear distinction between the role of ESMA and the role of the Commission, and I think that's important also for market participants to understand. We can take some questions from the floor. I look to the moderator from SEPS if some people want to come up. I want to take some questions together, but I also have questions in the question box. I think there was a question from Rafael Plata. There was also a question, as far as I remember, from Howard Miller, probably from Bill Sterling, from Philippe de Saugmont, from mostly market participants. So, of course, interesting because we have been speaking with supervisors and policymakers to have the market participants' views. I want to take the questions together. So if I don't hear questions coming up, I will take questions from the Q&A box. So Xavier, you can move on if somebody wants to raise a point directly. If I take questions, yes, Rafael, you can start.
Yeah, can you hear me,
identify yourself, please?
Yeah, can you hear me, Carol?
Yes.
Hi, this is Rafael Plata from the European Association of CCPs, EACH. Thank you very much to ECMI for such a factful study, and thanks a lot to the speakers. It's been really great to listen to you every time. Question on the, probably for Sean, but also probably Frukelien and Danuta may want to come in. It is about the proposed way forward of the European Commission on central clearing. Sean, you referred to it, Danuta also referred to it, and so did Frukelien in a way. Is it correct to understand that the proposed way forward on central clearing of the European Commission would not just be looking at the relationship between the EU and third country CCPs, but it would actually be broader than that, along the lines of what Professor Hubner was referring to, looking at the competitiveness of EU CCPs? I'm thinking, for example, we, the CCP Association, we tend to say that there could be a much more efficient process for approving enhancements to risk models in CCPs. Is this the type of issues that could be included there? Thank you.
Okay, thank you, Rafael. Anybody else who wants to raise a question live of the persons I mentioned, like Howard Miller or somebody else from the markets, just to complete this, because we want to move on? If not, I raise two additional questions and then we can turn back to the panel. There was a question, John, for you specifically from Hannah Brenton from Politico. How long could the equivalence extension run for, and what is the time frame considered? And related to that, there is a question from Robert Boy from ABN AMRO Clearing. Why not having an equivalence decision which is not temporary? Because if it were to be just a full equivalence decision, it would be much better for commercial parties to make their arrangements and their offerings, and to take away the stress from the markets and the clearing and the positions of clearing members and specifically. And there was also probably another question related to that, which can also be addressed to Frucolin, that we have now addressed UK CCP policy, but will that also apply to UK futures exchanges, and what kind of venues will benefit from this decision? So I turn back to the panel, probably start in the same order again with John, Danuta, if she wants to add something, and then also Frucolin. John?
Okay, well, thanks, Carol, and thank you for the questions. I think the first thing to say is that, of course, it's very difficult not to discuss this issue in the context of Brexit, because, as I said before, the trigger in many ways was Brexit, because if we had not had Brexit, we would not probably be seeing the CCP space as one of those areas where we need to talk about autonomy and worry about over-reliance, because we would have had a pretty balanced relationship, I said, between our internal and external reliance on reliance for CCP services. But I think it isn't just, and it should not just be seen as about moving business from London to the EU. This is about developing the EU's capacity. So it is broader than that. This discussion of CCPs also has its position in the discussion around capital markets union and building a broader, deeper capital market for Europe. So it's not just about Brexit. It's about what happens to the EU capital markets, which were under discussion before Brexit. It was a different discussion because the discussion of CMU with the UK in and the UK out is a very different thing. But it's not just about Brexit. It's about developing capacities in the EU. And of course, we need to look at how we can make any clearing capacity that we develop in Europe attractive, but also best in class. I mean, we're not going to be thinking about developing a capacity which is somehow inferior. We will want it to be best in class. So yes, we will be looking at ways in which our clearing capacity is competitive, is attractive. And to do that, of course, it will have to be best in class. On the equivalence decision, well, first of all, I cannot say how long the equivalence decision will be, because as the Commissioner mentioned in her statement, we want to see, first of all, what is the outcome of the ESMA process first, to see what this cost-benefit analysis looks like. That will give us a better sense of what might be required to be done. And then when we know what has to be done, well, then we will try to leave ourselves the right amount of time to do it. But of course, if we make it open-ended, the risk is, of course, that we will never finish. Always better to have a point in time that is sufficiently long to give you what the time you need, but not so long to create inertia in the system. So there will have to be, in my opinion, a timeline, but that timeline should be sufficient to allow us to get done what we need to get done, as I said, to make sure that this process, minimizes costs to the extent that costs will arise, and can be done in a way which in no way creates stability risk. Because as I think Danuta and Frucolin, we've all agreed that what we want to do here is to achieve our objective, but without, for the longer term, without creating short-term problems. So it won't be my decision, it'll be a political decision how long this will be. But I think what I can say is we will want to leave ourselves enough time to get the job done in an efficient and safe way.
Thank you, John. Danuta, you want to add something on competitiveness and on this equivalence decision, temporary versus unlimited?
Yes, I'm sorry. I just very briefly on some issues, because I agree with Sean that there is probably different argument in favor of temporary than an open-ended, but we cannot just forget in this context that an open-ended equivalence can also be terminated any time if the conditions emerge. I don't want to say that Sean wakes up in the morning and thinks, okay, today we are going to terminate equivalence for ACH or whoever, but because it's also a process and you have to talk, and there are a lot of things we have in email. But still, we have to remember that we are protected also by the fact that we can one day also terminate the open-ended equivalence. But I see this sense of temporary approach also because we have those two objectives. On the one hand, we test in a way our partner on the other side of the channel, and we look all the time at costs and benefits of keeping this openness. On the other hand, we just have this second very difficult challenge, which is building this supply capacity on the EU side. So we also have this temporary element, maybe mobilizing or facilitating also the expansion of the offer on our side of the channel. So maybe, we have to. I am sure that the Commission both and the ESMA will look into it what is better. But I see arguments for temporary, but under understanding that we are, without having temporary, we are sort of helpless. And if the situation comes, we cannot do anything, because that's actually not the case. My second issue on this competitiveness, I think it's extremely important, because we are, as we all know, the clearing is an enormous, in terms of amount of what is cleared, is just beyond any imagination. So it's a huge market, and it is a global market. And my understanding is that it will grow. And there is, as I was trying to say, there is a space for both the UK and the EU, even though geographically we are close, and in the traditional thinking of efficiency, one could say why they should just have the two markets, but I think it is not the case. So we can exist in the global clearing business with maybe some specialization, but we can just function, and it can be a win-win situation, because I also believe that the EU, without a strong powerful clearing business is in the long term, I think it would be just strange, frankly, with the size of the economy, and that we don't develop this. So I understand we have to do it. But stability, of course, is just fundamental, and this is why we have EMIR, why we have recovery, or whatever, R&R, resolution and recovery for the CCPs, also because we don't want a crisis. I mean, nobody wants, because it is a global, it would be a global crisis probably very quickly. So we need also competitive structures, and competitiveness on the European side is not only about having a competitive, attractive clearing houses, but also to build the competitiveness of entire capital market. And I think it's part of this, because of this interconnectedness that we both talk with Fuklin. I think it's important that we take also the competitiveness of the construction of the development of the capital market. I would love to say capital market union in single, that we took also at the competitiveness of this process of building the capital market in terms of efficiency, of speed, of robustness, and how important the clearing is for this. So it's all interlinked very strongly, and I like to keep the word competitiveness, I think, in thinking about the future of European clearing business and relations with UK in the context of our of building out of having a Europe also as a huge globally important financial center that I think Europe deserves to develop.
Thank you. Danuta, Frucolin.
Maybe I can start with the specific question about UK futures exchanges. And actually, I can be very short. The EMIR article that we base our assessment on is purely for CCPs. And a non-recognition, potentially, if that might be the outcome, which is not a given, would mean that UK CCPs can no longer provide their services to EU clearing members and EU trading venues. So it does not include UK futures exchanges. So in that sense, the answer is very clearly no. And on competition, that is always a very interesting topic. And I think Danuta and John basically said everything. Just maybe one remark to the report of ECMI, which speaks about a race to the bottom. I would say that is indeed a risk if CCPs would compete in an environment without any legal or regulatory framework. But I think over the years, this has been built up. And I'm not saying that this is not a risk competition on the risk management, but I think the regulation and the legal framework really provides a floor to avoid that we go to the bottom.
Okay, thank you. I can briefly move. We have 7 minutes left to a second round of questions. I will be brief. So John, Fruklin and Danuta. I mean, I have a question from Erik Litvak from SocGen, but also from ISDA. If you think about onshoring, John, it was a question to you. Do you see it specific to the euro, or do you have other currencies in mind? How will you achieve that balance between the euro and other currencies without undermining the ability of EU-based entities to compete in global markets? There is also another question about, I mean, going in the same direction. Also, yeah, if you speak about, given the focus on euro-denominated IRS, could we consider granting full equivalence in relation to UK equities and commodities, which are crucial for hedging risks by corporates, such as agriculture producers and manufacturers? And then a final question, probably, equivalence has been granted to US CCPs, and would the same concerns apply from euro clearing business moving from the UK to the US, which is a distinct possibility given the move we have already seen on derivatives trading post-Brexit? I probably stop it there because otherwise we will not end in time. I don't know, John, we should end in 6 minutes also to reflect your agenda on the onshoring of business from the UK.
I can try to be very quick here. I mean, all the questions that are being raised, and I've been reading them myself in the Q&A, I mean, they're all very important questions. They're the sort of questions we put, at least in the preliminary stage, to the working group and we heard coming back. So nobody, and certainly not me, is suggesting that this is all a very simple operation and that what we're going to do is very, can be done quickly. If it could be done quickly, if it's done easily, it'll be done already. So this is something we have recognized, particularly on the basis of the work we have done with the working group, will require some preparation. I would stress again that this is not about closed Europe or protectionist Europe. This is not about onshoring everything that's euro and having nothing that's euro left in the United Kingdom. It's not about creating a sort of euro-based, Eurocentric, euro-only clearing capacity in the EU. It's about developing the EU's capacity. Who knows, there may be, in time, a global dimension to the EU's clearing capacity as well. And we tend to, I'm going back to my very long ago Giovannini days when we had a long chapter in, I think, the second report, where we couldn't decide among ourselves, although Alberto never admitted we couldn't decide, but we couldn't decide really whether or not it was better to have a single CCP or to have several CCPs that were interconnected, and whether one or not was a better. We kind of concluded that having just one in the world probably wasn't the best. Having 35 in the world, probably not the best either, but there was room for having more than one CCP doing the same business, okay? So competition among CCPs was not necessarily something to be excluded. So of course we have to throw our mind a long way forward here to think of what exactly we want to do in terms of building the EU capacity, but don't always think of it in this very narrow terms of, you know, EU stealing business from the UK to set up its own little EU-centric shop, and that's it. That's not what we have in mind for the longer term, and that's where you have to think of it in terms not of Brexit, but in terms of the Capital Markets Union plan and what our plans are for capital markets in general, for the EU going forward, which are not closed at all. We want them to be as open, if not more open, than they are today. The point about equivalence decision is well taken. The equivalence decision, as Frokelin explained, applies to the regulatory framework for all of these infrastructures, and then Frokelin focuses in on particular CCPs within that. So it is unfortunate that some of these other infrastructures are covered by equivalence decision, but just to be clear, you know, we are aware of the difference between, let's say, some elements, some infrastructures in the UK, which are either not systemic in any way or are such that we would never want to create such a capacity in the EU, and CCPs like we're talking about here, but they're all covered by a single equivalence decision, and we don't do separate equivalence decisions for separate infrastructures. And then on the US and the UK, well, as you know, if you read EMIR 2.2, we have a tiering system, and the US CCPs today are within tier 1 because they fall below certain thresholds. Of course, it would be possible that if all this business left the UK and went to the US, that those CCPs would then go above those thresholds. But as I said before, the objective here is not to be necessarily taking business from the UK just to put it somewhere else. We want the business to be in the EU. So, you know, the objective will not be to keep our external reliance, but just have the external reliance on somebody else. The objective is to rebalance that internal external reliance. So it has to come to the EU. That's the objective. So our plan is not to shift it from the UK to the US.
Thanks, John. Rapidly, I move to Danuta and then finally to Frokelin, or probably my colleague Apostolos. Quickly, Danuta.
Sorry, but I would just like to use my 20 seconds to ask one more question, Sean, because we had this debt issued under SURE program, which was, I think, cleared by LCH, is used as collateral. We will have 800 billion euro debt issued in the context of New Generation EU. Does those issues pop up somehow in the discussion in the Commission among whatever, in the context also of equivalence?
Yes, I mean, I think we would like all of those transactions to be managed through EU infrastructure to give some liquidity, some volume to the market. I think that's certainly possible to do.
Okay, very clear. Frokelin?
On the tiering, Sean said it all. On the scope, UK equities and commodities were mentioned. I just one small final thing on the assessment report. We include that in our assessment too, because we have this comprehensive view on the CCP. Thank you.
Thank you. I don't know, Apostolos, but do you want to add a final word?
Yeah. A few final things. I mean, I hear what Sean said about EU doesn't want, the Commission doesn't want to fragment the market. Danuta discussed about competition. Some refer to, you know, a fragmented market means more competition. So this is a bit always a trade-off between, you know, how much competition, how much fragmentation, what is the impact to stability and so on. And the other important thing is the supply of products. So increasing the capacity of EU CCPs to clear different products, different multi-currencies, which is also very important. That's it. Thank you very much for the discussion and, you know, all the input from Danuta, Sean, and Frokelin, actually. Very helpful.
Okay, thank you, Apostolos. And with this, we can end in time. It's 4:15. My great thanks to John, to Danuta, to Frokelin for a very interesting discussion, for a very clarifying statements on what we need to plan for. Also, thanks to my colleague Apostolos for presenting the study. As I said, the study is available on our website. We are open to any further suggestions or any further comments you may have. You can always consult as well the ECMI or the SEPS websites, and we hope to see you in the future again at any of our other seminars. We have further seminars planned at the end of this month related to our ECMI annual conference, where we will discuss private equity and CMU. We'll also discuss cryptocurrencies and what to do. And we'll also discuss finally also the public debt markets and above all the euro or the EU related debt markets and whether it will achieve more capital markets union. So thank you for listening in. We were about 190 persons who effectively participated, which is great. which shows there's a lot of interest for these matters. Thank you very much again to John, Danuta, and Fruckley. Bye-bye.
Thank you. Bye.
Thank you. Bye.
Thanks.